afternoon, everybody. Thank you for joining us again for the weekly barometer readings, where our portfolio manager, James Callahan, and I will walk you through our stream of consciousness as it relates to markets and portfolios. David Burrows is still traveling, but he will be back next week. My name is Diana Avigdor, and I'm at the head of trading, and my job is to measure the temperature of public markets and other asset classes from a micro and macro perspective. With me is James Callahan, who is portfolio manager, and after a brief 1,000-foot view of the last week in the markets, he will discuss our portfolio structure and direction. Markets last week did really well. They were up about 5%, the third week in a row. And the TSX is making new 52-week highs. Last week, we discussed how indices have reached critical technical levels that allowed us to lower some of our fairly high cash levels and engage with the market by adding some positions. James will take you through those. We still, however, have some cash. It's a little bit elevated, but not as much as it was about a month ago. On Friday, Moody's downgraded the debt of the United States. So yesterday was price discovery day, and the market took it pretty well. So that was encouraging. Really impressive reversal yesterday through the trading session, as Treasury yields finished the day actually down and lower than they started, while risk assets completely rebounded, and we ended the market flat. In U.S. Treasuries, the 5-year and continues to perform really well with a broadly steepening curve. Impressive on the equity front. So it's the way the market is positioned to take in the news, and lately the market took in stride all kinds of news that could be perceived as negative, that say about a month ago would take the market down. Let's begin. I have a few slides for you to run through the week, and then, like I said, James will go through the portfolios. This is the TSX, this is the S&P over the last 6 days I have here. Like I said, markets behaved very well last week and into this week, despite the debt downgrade. Likewise, NASDAQ acted pretty well as well. And the TSX Composite at a new high. This is, we had another high today. This is the 4th high of the year, and internals are strong. Strategas notes that the percentage of TSX constituents trading to a 1-month high exceeded 50% last week. This is historically rare. It's not as reliable a measure as U.S. indices because we have less data, but we still view strong internal momentum as favorable, especially coming out of corrections. The most incredible about phase happened the last 2 weeks. Flow of funds went from extreme selling to extreme buying, a healthy dose of fear of missing out, and to a lesser extent, short covering. And while it looks extreme, let's see the context again. For those that were with us last week, I showed this chart last week where gross versus net exposures are so far apart. And what I said was this needs to close somewhat. This points to extreme bearishness where everyone is positioned on one side of the boat. Morgan Stanley quantitative trading desk noted yesterday that they had lots of inbounds questions in the morning. Like I said yesterday, market ended flat after opening down about 1% on the Moody's downgrade. And they got lots of calls asking them who was buying. And the answer is always the same in the last few weeks. The US downgrade really didn't change the setup. Macro systematic is a buyer of about $5 billion a day. Buybacks are likely running at $4 to $5 billion a day on average post earnings. And retail is buying, choppy, but at least on pace for $5 billion a day. And really, it's a 96th percentile for this kind of demand. And that demand is likely not being met with institutional supply, at least yet, given this kind of exposure, which is pretty low. At some point, the rally will be met with fundamental supply, but somehow the market action and the market narrative are as far apart as could be. The narrative is fairly negative. We're talking inflation and slowing growth and tariffs, and yet the markets are really defying gravity and do not and are refusing to price in recession, even though a lot of people are talking about it. So big differential between what we're seeing and what we're hearing in the headlines. We can also see that the demand of call options relative to puts is at the highest level since February. Remember, a call option is the right to buy the market at a certain time in the future. A put is the opposite, the right to sell the market at some time in the future. When people buy call options more than put options, it means that they're buying upside, um, or they don't want to be at risk for not having upside, and they're willing to pay a premium for it, or they're hedging shorts. And if I go back to this chart just shows you that there's lots of shorts out there in the market when gross versus net is when the net is so low and gross is so high. It just, you add them up and it shows you that there is exposure, but a lot of it is for the downside. So this could be a little bit of hedging against that big short position. Despite the end of US exceptionalism trade that's being discussed ad nauseum, and perhaps that is what's going on. It's been a couple of decades where US was almost the only place to be. Flows to all markets have been positive. What is a common denominator, however, is that people want to own the largest of names with the earnings, safety, and visibility that it comes with. Here we can see in the red line the cumulative fund flows into the US, the slight compliments of Bank of America Merrill Lynch. You can see the cumulative outflow out of US small cap stocks, which is really a head scratcher if you believe that the Trump presidency will Make America Great Again back home, where taxes are lower, manufacturing jobs come back, and every American is experiencing the golden age. What this flow is telling you is that the fear that it's the smaller companies that will have a harder time adjusting to the new regime with perhaps higher rates, higher labor costs, and higher input costs due to tariffs. This next slide shows us the cumulative inflows into European stocks, not since 2015. Like I said, it's been a long time since it made sense to be anywhere else. We recommend at least a 10% exposure into global markets, and please talk to your barometer advisor if you want to learn more about how to go about that. But this is finally the time where you're able to buy other markets, and it's really a valuation call. They're cheaper, and they're moving. Look at the TSX 52-week high. So is Europe in many ways. So these are the flows into Europe, and they've been strong, and we haven't seen it since 2015. I just wanted to touch on a little bit on why Moody downgraded the U.S. on Friday. President Trump calls it the big, beautiful new bill, and the big, beautiful new bill increases deficit by $2.7 trillion. What the Trump administration is hoping for is that economic growth plus tariffs will more than offset this, and economic golden age will naturally increase the tax intake. President Trump's nudging of Fed Chair Powell to cut rates, if works, will lower the interest paid on that debt. $36 trillion in deficit does not go away overnight, for sure. Moody said it expects federal deficits to widen, reaching nearly 9% of GDP by 35, up from 6.4 in 24, driven mainly by increased interest payments on debt, rising entitlement spending, and relatively low revenue generation. Trump doesn't believe that. He thinks we'll be opposite. Treasury Secretary Scott Bessent dismissed the cuts significant in a pair of Sunday television interviews, saying the GOP's tax bill would spur economic growth that would outpace what the nation owed. He said, I don't put much credence in Moody's downgrade. And to be fair, Moody is the last agency to downgrade the US. The other two downgraded the US long time ago. So that's like telling us what we already know, and markets just ignored it. Morgan Stanley says investors should buy the dip in equities after the credit rating cut. And he's been pretty bearish for a long time. But market has rallied a lot from lows, so we'll see. If the dip gets bought, then that tells you something. Same as was Friday's Michigan confidence, which I will show you in the next couple of slides. Inflation numbers were ignored. Traders don't have views, they just note the setups. Back to flows. This is fixed income flows. Bank loans, corporate high yield, EM, emerging markets, debt, all risk proxies have been bought. So the bond markets experience some of the same risk-on moves as the equity markets, with money flows, with money market flows, as you can see in the red, negative, which these are usually used to purchase other assets. Now, the direction of bond yields may certainly test the stock market rally, but so far, it's been well behaved. We know, though, that when bond yields spike, especially if they spike fast, equity markets don't like that. It's okay if they are orderly. Probably can be up to 5.5 on the 10-year, and maybe 7% on the 30-year, which is sub 5% now, but orderly, as long as it's orderly. I have a feeling we will see a Powell cut before a hike. Savita Submarian from Bank of America Merrill Lynch notes that if rates continue to rise, it's seen as a risk to stocks. But in actuality, there is no magic number for when long rates hit equities. Tariffs uncertainty, perhaps more behind us than ahead of us, and a weaker dollar could be positive for earnings. Tech, materials, and energy have historically been bigger beneficiaries of a weaker dollar, though there is a lot of moving parts here as well. Certainly, markets are taking bad news very well, and that tells us something. Cautiously optimistic. Lots can still go wrong, but this administration is very vocal and very unpredictable, but market has really pulled up. This next slide shows us what I mentioned before, is that the University of Michigan inflation expectations have gone up a lot at the headline level. But if you break it up by party, you will see that Democrats are more bearish than the Republicans by far. Democrats see 10% inflation, while Republicans up from deflation to only 1.2%. Fed Chair Powell highlighted this in his March press conference and dismissed the sentiment survey as being overly partisan. Certainly, it's nice to see that people's asset allocations are not that much over their skis. This is Bank of America's survey of private client debt holdings as a percentage of assets under management. The allocation is firmly below average. In equities, they are a bit above average holdings, off highs, and there is room to take it lower. At this month end, we calculate equities for sale and bonds to buy from asset allocators, hence we could be a little more quiet here into month end. Certainly from a portfolio perspective, I think we are not on the front burner anymore bubbling. We move to the back burner into a simmer until next catalyst will hit. We are going into a long weekend in the US, so I expect markets to be quiet, less volatile, and lower volumed. We have Monday Memorial Day in the US, but next week we get important data, GDP, PCE, those are all important stuff. Remembering that valuations are not that extended and earnings growth and earnings expectations are what matters. The collective forward PE of Mag 7 has gone up from 21 on April 8th to 27 on Friday. It was a big rally. Excluding them, the forward PE of the remaining S&P 493 stocks is only 18.5. Earnings growth of Mag 7 was 28%. So you might ask, okay, but the rest are not growing. Well, the rest of the S&P was actually 9% growth in the last earnings. Not bad at all. And as you can see, the expectations for next year are also pretty high. So they're still solid. We'll be watching this very closely. And this is my last point to you. I would like to bring in James Callahan to talk to you about our portfolios against this backdrop. James, thanks you for joining. Over to you.
Thank you very much, Diana. I'll just take over the screen share here. Just give me a second. There. I think that should be showing. So apologies for leaving everyone on a cliffhanger last week, but I'm happy to be back on to discuss how we've positioned our portfolios, how that's changed over the last month or so, and what we've been buying. So I started with this chart last week, so I'll put it up again now. The rally has continued. We've caught some upside here, so we're happy that we've added exposure. I mentioned this last week, but I do have some good charts to share on this now. So with recognition that we remain in a very uncertain macro environment, hence the cash position that remains in portfolios and that Diana discussed, and I'll get to that later. Directionally, the tariff situation in the US is getting better. So this is a chart on effective tariff rate for US imports. As you can see, it's come down from a peak of 26% to 13%, which is more manageable. So as the administration has talked about a global minimum import tariff of 10%, maybe we stay around these levels. Some countries are going to come in higher than 10%, of course. But this is manageable, and it's not the end of the world for US companies or US consumers at this level. Another chart as well. When you look at the number of containers on the left and vessels on the right that are sailing from China to the US, they've begun to pick back up since the last de-escalation, which bodes pretty well. That's something that we're going to watch. This chart's from Morgan Stanley. They've done a good job tracking this stuff. So moving now to our exposures, this is where we sit now on a firm-wide basis. So this chart shows our current exposures across the firm versus where they were last month in light blue versus S&P 500 sector weight in red. Individual client accounts may look different than this. I just say, this is an amalgamation of all client accounts, but this is generally where we are. As you can see, over the last month, we've added the most to financials and industrials, and we added these exposures by deploying some of the cash that we'd built and kept on the sidelines, as well as some profit taking in our gold exposures. So to start with financials, so far this year, through the market weakness, we've maintained our positions in the insurance industry. Fairfax Financial remains our biggest position as a firm. That's worked very well, has been an easy one to own. But in terms of what we've added, or in many cases added back, in the banking industry, a familiar name here, JP Morgan, they continue to benefit from economies of scale. They have a nice diversified stream of revenues and investment in consumer banking and wealth management. And as US economic outlook improves, JP Morgan shares are working. So that's when we've added back. Morgan Stanley, a bit more focused. Their wealth management and capital markets businesses move the needle for them. Their e-trade business is great as well, as retail volumes have been high. That's one we like as well, and we have added recently. In Canada, I know this is always of interest. We've added BMO last week. It yields almost 4.5%, and they grow it pretty nicely. It seems to be playing a bit of catch up to some of the other Canadian banks, and I'm sure this is one we're going to spend more time on next week's call, as the Canadian banks are set to report earnings next week. So outside of banking, in the financial sector, still in payments, we've added Visa, so one of the all-time great compounders. Their dominant position in what is an oligopolistic business ensures they grow earnings at a steady clip. Visa does the best when people are traveling. Since they make a good amount of their profit on cross-border transactions, that's always important for them. Airline traffic remains solid, growing 13% year over year. So that bodes well. That's a leading indicator for Visa's business. So all good there. And yeah, really through the correction, the financial sector has, exhibited many of the leadership characteristics that we look for. On a relative basis, it outperformed. The breadth data remained solid throughout. The insurance industry specifically was a bright star. So as we've put capital back to work, we've wanted to increase financials exposure. Another leadership sector, industrials. So we've been putting some money to work here. This is the chart of the sector itself, back to highs. As with the financial sector, you're going to see some familiar names here. Many of these are names that we sold as correlations went to 1 during the sell-off, and most stocks traded terribly. And we do that to preserve capital. That really is the core of our selling strategy. We aren't shy to add back some of our favorite businesses on the other side, and that's what we've done here. So Axon is a name that should be familiar. I'll highlight this chart first. So the breadth inside of the industrial sector has been as strong as it gets, really. when you look at the percentage of stocks above the 50-day moving average, really, really strong. 96%, very strong breadth. So another reason why we've wanted to increase exposure here. And then moving to Axon. So this is one we've owned in our equity strategies for about 3 or 4 weeks now. So it's not really a recent addition. But Axon has been firing on all cylinders when it comes to innovation. They've been introducing plenty of new products across all their verticals. All have been getting good traction. One specifically, they released an AI report writing software that I have talked about during this call in the past. It delivers very, very strong growth, comes at very high margins. This software, what it'll do is piece together information from police dash cams, from body cameras, from 911 calls in order to automate report writing. So police officers using it report hundreds of hours saved. And if you're a police department, you want officers out, serving and protecting, not sitting in an office writing reports. So this product is a no-brainer. Axon's worked well for us. GE Vernova. I've been on this call at various times in the last year to talk about this name. They're the biggest producer of natural gas turbines. They'll be instrumental in generating enough power in order to meet projected power demand coming from things like data center build out. We learned recently when the company last reported earnings that they've grown their backlog just a ton. So backlog for them is basically their order book. So they've grown it to $124 billion. And about 60% of that is service revenue, which is amazing. It comes at nice high margins. Within that backlog, they have orders for 60 gigawatts of gas turbines, which is just a huge number. That's more than 3 times the amount of energy needed to power every home in Canada. So they continue to fire on all cylinders, really, really strong business. And then GE Aerospace, the jet engine manufacturer, they continue to see strong sales as well as growth in their repair and overhaul business. So as Boeing struggles to deliver planes, GE Aerospace wins more business in repair as aircraft fleets age. So a lot to like there. So anyway, this week I promised sectors and names. I didn't want to keep anyone in suspense any longer. So this is where we've been adding exposure. And again, I'll say, we manage the different mandates in different ways. Not every position is going to be suitable for every portfolio. So if I've talked about a name and you're not seeing it, that we own it on your behalf, there is a reason for that. It may just be a timing issue, maybe something that we're looking to add soon. We just want to be as transparent as possible on these calls and try to give as much insight as we can. So with that, that's really all that I had. I will stop the screen share and I will take a look in the Q&A. I see a question on Dave speaking about gold versus tech. What is our view? So this is definitely a subject that Dave will touch on next week because he'll be back running this call next week. On gold versus tech, what I'll say is Dave was very quick to inform us as the portfolio management team a few weeks ago when the price of gold was going parabolic and a lot of the gold miners, had delivered really, really strong returns, to say this may be overdone. So why don't we take some money off the table here? And it was absolutely the right call. That's what we've done. We've taken some profits and it's been absolutely to the benefit of our clients. Gold price has been a little bit weaker. It is still our plan to own gold names, to own the gold miners. They still look okay, but we did want to take some money off the table because we'd had such strong returns based on our gold positions. As regular viewers on this call will have seen, these have been positions that we've been talking about for a long time, that we've owned in client accounts for a long time. So we delivered some strong return, took some money off the table. And in relation to technology, we did add some technology names last week. We added Microsoft in portfolios where it made sense. The breadth data, while it's still very early and on a relative basis, tech has not outperformed. The breadth data coming out of the technology sector last week in the US was very strong. And so the way we're thinking about it now, the right percentage of tech exposure to own in client accounts here isn't 0. So we're adding some positions where it makes sense. It's not our intention to go back to a market weight in technology, which would be 30% in the US. That's far from our intention, but to add some names around the margin where it makes sense is what we're likely going to do. based on the breadth data within the sector. So that's what the view is there. And with that, I don't see any more questions. Thank you all for joining. If you'd like today's presentation, I'm always happy to send that out. Please email me at jcallahan@barometercapital.ca. I can send that out to you. And thank you, Diana, for joining. Thanks everyone for your continued support. And we'll have Dave back next week. So make sure to tune in for regularly scheduled programming, and everyone have a nice evening. Take care.